Hi, I'm Roy Collin, the host of the podcast. You can find everything about me by scanning the QR code there or going to roycollin.com. And you'll find my six podcasts, the Podfather, helping people become podcasters, the Awakening, exposing fraud and corruption, but with solutions, the Crypto, all things blockchain technology, meditation podcast, speaking podcast, and the Learn Polish podcast. You can also help the show by actually making a donation, visiting the store, or helping my sponsors. I hope you enjoyed this week's show. Welcome to the Crypto Podcast. You can find all our episodes on thecryptopodcast.org. My guest founded Mendoza Ventures to take an in-depth focused approach to venture capital, looking for founders who demonstrate domain expertise in one of three focused areas across fintech, AI, and cybersecurity. With diversity playing an important role in their investment decisions, about 90% of their portfolios consist of startups led by people of color and women. Since its founding 7 years ago, Mendoza Ventures has raised two funds and have four successful exits. The firm is currently raising its third fund, the 100 million fintech fund anchored by Bank of America. My guest has received a bachelor's from the University of South California and his master's from Harvard University from Boston in the USA. Please welcome Adrian Mendoza.
Roy, thank you for having me.
Yeah, no problem. I suppose we have to start off because I've seen some of your videos, but you got that beautiful puppy next to you. And
I did. My little buddy here, the VC puppy. He's our senior associate at our firm, but he goes to every time an investor comes into the fund, they get a puppy. Every time we invest in a company, the CEO gets a puppy. And he goes everywhere. He's traveled everywhere. I had an investor take him to the UAE. I had an investor take him to Tokyo. So puppy gets around.
And even with your team pictures and everything, there's a picture with the puppy, and
Oh,
it's. I think it's actually very good to have a kind of that marketing thing for it. But have you got any backlash? Because you know the way some people they don't accept the fun. I mean, life is about smiling, but
You know what? 99% of people that we meet love Puppy. Then there's 1% of people who hate him and they don't have a soul. He has an Instagram, and remember I was at an event and someone said, "Oh, he has an Instagram." So they opened it up and they were offended. They said, "Why is he not working? He should be working on spreadsheets." And I said, "Oh, no, Puppy likes to get around." They were just totally offended by it. And I was like, you know what? You can't make everybody happy.
yeah, yeah. So I mean, I suppose let's talk about the areas that you specialize in: fintech, AI, and cybersecurity. I suppose let's learn about a bit more about yourself and then why you kind of chose them areas.
Yeah. So prior to being a VC, I was a founder. And one of the things that was interesting is while I was a founder, I bootstrapped a lot of my companies doing work for financial services, for the banks, for asset managers. I was building out their mobile presence. I was building out their brokerage presence. And so that gave me this incredible skill set that I took into my startups. Like we were building early AI, early cybersecurity. We were building fintechs before they were fintechs. And so when I wrapped up my companies and we switched over to becoming investors, one of the things that I did is we looked back at, like, as an investor, you could see everything. Like right now, even like my team yesterday, they were approached by someone with a fizzy juice. We don't invest in juices. Like, I appreciate this, but like not a fit for us. We invest in technology companies. And so when we took a step back, we've been around for 9 years now. We looked at where were areas that we had domain expertise, where were area that we knew the customers, we knew the partners, we knew the founders, we knew the investors. And it was really around financial, technology. It was around AI system very early on. It was around cybersecurity. But now I like to say that we invest in areas that need innovation, modernization, and disruption. And they're affecting spaces like manufacturing, like financial services, like insurance. And this is why some of our companies are successfully building things for the banks, for the asset managers, for insurance companies, for manufacturing companies, for the use across building software to building physical products. And that's really exciting because you would think that we're in 2025, that every aspect of the economy worldwide is covered with technology. The reality is it's not. And there's still this massive opportunity to build companies that have value and that could build interesting technologies to help. And I think that's especially on the AI side, which is all the hype, but on the big believer is also on the movement of money. And that's where sort of, we connected on this podcast, on your crypto podcast, to talk more about that, because we're early investors in blockchain. By early, I mean 2017. For us, we have one company we invested in 2017. This is our deep tech investment. It's now finally coming in front of the regulators and getting approved by them in the next, like, knock on fate wood, 2 weeks to a month.
And how are you seeing this industry going? Because my pet peeve is in the financial world. I mean, obviously, like Visa, MasterCard, they take such a cut, but like even payment structures, like, money-wise, for those that kind of are just going and collecting it, but like PayPal, take anything from 5 to 10%. And I mean, most of the time, where it's going, to Asia, Bangladesh, Pakistan, stuff like that, that's a lot of money for them when you're taking that kind of percentage. Have you seen anything, or is there hope that, well, like I know there's talk about XRP and everything, but can you see anything that can change that?
Well, it's interesting because I was talking to a bank yesterday, and I was talking about 2 or 3 portfolio companies. And I was walking through this idea of, hey, we should be using general ledgers to move money from one place to another. And the guy's looking at me and he's like, you know what you're describing? I said, I know exactly what I'm describing. I'm describing a blockchain network with an immutable ledger. And he's like, I don't know if we're ready for that. And I said, that's why I'm not describing that. I'm describing how it should work. If you want to interpret it as a blockchain, then yes. But the reality is that the movement of money still has to get disrupted, because, like, I'll predict that in 5 years, the reality is that the FX desk will no longer exist. Like, the buying of currency will no longer exist, because you should be able to trade specifically US dollars to Irish, or euros without an FX rate. But the reality is there's still so much infrastructure in financial services that it's, to innovate. And I'll tell you, when I bootstrapped my company, I was doing some work at a bank, and they wanted to take a project where they built a platform, and simple, just like on the screen, take data. The world's financial data was passing through this financial services company. And they were, and so that, how this is just like 15 years ago, and it's still going on today. They were taking data, and I'll use this good example. They were putting it on a USB key. They were taking it, they were running a floor above. An analyst would then crunch that data. If they got an error, they would run it back down. This was a sneaker net. And I was like, this is like 2012. Like, this should not be the case. Like, we should have Excel, spreadsheets and this should go into a database. And even further on, post my startup, I was an entrepreneur in residence at one of the largest insurance companies. They still weren't seeing data in a database. They were still seeing the world's financial data in a daily basis on paper. So before we even get to a blockchain or stable coins or tokenization, there still has to be a modernization of infrastructure. And so that's what's taking so long for the adoption, because when you look at the advent of stable coins, and especially with decentralized finance, where, if you look at 10 years ago, you couldn't build a fintech. Now you can go and buy all these pieces of the puzzle, build your own bank without any issues, because you have all the infrastructure. And that's the hardest thing, is just the adoption of it.
And just on the FX, like at one stage I was doing the currency exchange. I was doing a lot of property in Poland, and most of the banks were like charging 5%. And there was even times in Poland if people were looking, I think if they were going from the dollar, they would tell them, one bank was saying, oh, they had to go to euro first and dollar, and they were charging them like 9.5% or something like that. But like we were doing it for 1 to 2%. But then when, like, you had the likes of Revolut and stuff like that, and it's very competitive. If you get like the metal card, it's 0.3% or less. It's very good, the rates. But the problem is with a load of these like Wise as well, you can only use them in certain countries. And most of the time people are actually dealing, they might have virtual assistants or something like that in different countries that it's banned in or it's not allowed. And that's when it becomes very difficult then to actually get a good exchange rate.
Oh, and also because when you look at the movement of money, we're still using intermediary banks. During COVID, we sent a wire to a Canadian startup we invested in. This was like, 100,000 or something. That got stuck at the intermediary because it was a holiday and because it was COVID, there was no one at the desk till like at the end of the week, until the end of the week where somebody looked at the wire and was like, oh, this should go to TD Bank or wherever it was going. That's how physical the process still works. Like that shouldn't be the case. We should be able to direct dollars from one place to the other without an FX rate, without an intermediary bank, because that's where you're losing dollars. And it's interesting because a couple of years ago, I was quoted somewhere saying that I was quoting an American banker that I said, when we start looking at decentralized finance, a lot of the traditional players are going to get hurt and they're not going to be able to catch up. Funny enough, Synapse took my quote and started using it for marketing without my permission. And I was like, no, guys, you are the ones that are going to get disrupted. Funny enough, last year they went out of business. And not only that, they took with them 5 startups because they literally used their funds and bye-bye Synapse, bye-bye 5 startups. And that's where kind of we're starting to see, because one of the other things that we're happening that we're going to see this year, there's going to be a lot of this excitement about crypto. There's a lot of excitement about, new regulatory changes here in the US. And I think there's going to be a lot of banks being like, oh my God, we need to do something. We need to custodian these assets. We need to like make money off holding crypto and tokens. Towards the end of the year into next year, a lot of these people are going to wake up and we're like, my traditional KYC doesn't work for tokenized assets. My traditional, banking core doesn't work for holding tokenized assets. And we're going to see people wake up and realize that they've got to look at how they are a custodian and how they take traditional assets against digital tokens.
Are you seeing anything with simplifying the process? Because, I've had a lot of guests, they've lost a lot of money because, they got scammed or they put in the wrong code or something like that. And that's the fear with a lot of people. And to get to the masses, for me, like say a system like Revolut, it's very simple to be sending stuff like that. So that if it was done in a way like that for the blockchain technology, but the problem is, like most people, they're terrified of actually sending it. So you've got a certain small percentage that are okay with this, they're comfortable with this. But we're not talking like, I don't know what percentage of it, but just 95% of the population still aren't using this. And can you see something being developed, or is there something in the pipeline that's going to simplify it?
Well, part of it is interesting. It's one of the hardest things is that I would say, and I'm going to throw this crazy number out there, that from what we look at, 90 to 95% of all stable coins are backed by Bitcoin and Ethereum. And the reason being is that it's easy to use Hyperledger. It's easy to like stand up a blockchain to, build a tokenized asset. But then the problem is, as currency rises and falls, it affects 90% of all tokens because they're all backed by the same 2 currencies. And so one of the things that we need to see, and I had this conversation with the bank yesterday, is, one of my fellows, one of our MBA, young associates was like, before that call was like, why aren't they using a stable coin and backing it by US currency in order to move money from one place to another? And it was like this really simplistic view of, yes, he's totally right. But for them, I said, when I had this conversation with the bank, I said, well, here's the reason that you want to be careful with it. And this is actually the reason why, the failure of the last couple of exchanges, we saw, the failure of the US exchange that went down and the other one that was in Canada. I always space out on the names, but everyone here will remember these grand failures of exchanges, is that assets were tokenized. The underlying assets were fine, but the more you trade and move money around, guess what happens? Is those coins and those tokens increase in value because you're moving them. Well, what you don't want to do is hang your hat on those tokens as a value or an asset, because inherently, without without an ability of liquidity, they're useless. So I remember talking to a founder out of the UK that said that was moving currency and had built a tokenized system, which was incredible. Loved what he was doing. And I looked at his balance sheet, and there was this massive amount of like, hey, wait a minute, what is this balance sheet? Oh, these are the tokens, and it keeps on rising and rising. And I said, well, how are you going to get rid of those tokens if you have value? Well, I'm going to put them on FTX. A month later, FTX went down because of the same thing. They were literally putting credit against those rise of tokens. And so that's the issue, is that we see this like inherent value being created. You want to do something with it. But the reality is, until you have access to liquidity, there's no point. And it was funny enough, because in the beginning of when we started investing in blockchains, we said the real innovation will come out of private blockchains. And we had a lot of other tech investors that said, you're wrong. It's going to be public blockchains all the way. And I was like, nope. It's going to be. And guess what? The successful blockchains are private blockchains you've never heard of. You have, years ago, JP Morgan moves money from one office from treasury to treasury using their own private blockchains, using a JPM coin.
Like with the exchanges then, because I mean, Binance, all of them. I mean, they've made it so difficult. It's simple when you want to buy something, but to sell it, they're actually they're making it painful for people. And like, one is obviously protecting your wallet and taking it off the exchange. I mean, I know if you're trading and everything like that, but can you see people simplifying that and getting that? Should know your customer. I mean, there's a lot of regulation and everything, and people seem to want regulation when they're getting scammed and everything. They want to be protected, but when they want to do all the transfers, they don't want nobody knowing because they want to keep it in their own pocket. So it's a catch 22 situation.
Part of it is, this is a twofold question. One about KYC, one about exchanges. The biggest issue right now, and I see this especially now that like PayPal and Venmo and Robinhood are getting into the selling of crypto. One of the things that individuals, the retail investor that buys this doesn't realize, you don't own that. You don't have a wallet assigned to you. It's bought into a general ledger. Robinhood owns that. So if you wanted to sell it, unless there's somebody that wants to buy it, it's not like, public equities and public securities, that there's market makers, there's people that are buying it without you needing to have a buyer that'll then liquidate it on the other end. No, it's like, it really is very clear. If there's no one else to buy this, because this is like blockchain 101. If there's no one to connect to the next block, you're not going to have a liquidity event. And what you see is things like, these meme coins that are going out, increasing in value. And then when things are going south, no one has any liquidity because nobody wants to buy them. So therefore you can't get rid of it. And that's, I think, the inherent risk is, one, you don't own it. Two, there's not enough liquidity on the other end, because there's not enough, unlike public equities, market makers, custodians that'll buy it. So it really creates this very one-sided like experience. And that's sort of where a lot of the education isn't for those that are buying cryptocurrencies, because there's always going to be someone that wants to buy the big ones. But traditional like meme coins or meme tokens or stable coins, like, there has to be a liquidity event on the other side. And it's hard because, there has been so much failure in exchanges recently that I think the need was to regulate them. But coming into the next 4 years, we're not going to have regulation. We're going to have a deregulation that's going to happen to the banks and to tokenization. And part of that regulation is, we still have not yet defined, where do these exchanges live? Are they on the public equity side? Are they financial assets? Are they MSBs that are using it to run, like, if you look at, the banks are highly regulated. And so in order to open up a bank account, you have to go through bank KYC, the Know Your Customer, AML. Well, if you're doing remittances are less regulated than the banks because people are just trying. And so there really hasn't been this idea of where do these use cases live because they're still outside. They're outside the US regulated industry. And so that people remember like 15 years ago, 10 to 15 years ago, gains and losses were not reported by the IRS. Only just recently is the IRS saying, hey, did you make any money from digital assets? That's fairly new.
And with the cybersecurity then, because I mean, you can trace with the ledger, you can see everything where money is going and all that. But when people are ripped off, like, connecting with AI and everything, I mean, they have to take their funding out some way. Reality is, it is traceable. Well, it should be.
Oh, but it is.
Yeah. So how are people?
Exactly. You know what? It's funny because the fraud isn't happening at the blockchain level. It was funny because I remember reading something years ago. This was a long time ago. This is around 2015, and it still holds true to today. And the article said, look, if you had enough computing power to change the direction of a block, to overwrite a transaction on the blockchain, you might as well use that computing power to generate your own blockchain, your own coins and your own cryptocurrency. And they're totally right. Like if you had that level, no one's going to, steal a transaction unless you're openly giving the wallet away. And that's where people is like it's the blockchain is secure. It's everything else around it. The KYC, the people doing phishing attacks to get access to somebody's wallet and like PayPal and all of that. That's where the real issues are happening. It's everything around the blockchain that is the UI level. It's the phishing attacks have gone up, fraud attacks. We've seen the number of, I would say, my God, it's now like more than I can count that we will meet startups or businesses that are doing AI-driven lending or AI-driven transactions, and the APIs are not protected, and someone injects a fraudulent attack through there, or they create a synthetic identity and they simulate KYC and they steal fraudulent money through there. And that's interesting what we're seeing because the more that you have decentralized finance, and that's all driven by microservices architecture, it's all driven by API transactions, that's where the fraud is happening. And that's what we're seeing more and more coming into this year, next year, is this waking up of, oh my God, yes, it's easy to build a fintech. It's easy to move money. It's easy to do all these things. But there isn't this insight of, oh my God, we have to protect against all of these simple attacks, because these attacks aren't coming, especially on the cybersecurity card, they're not coming from these big hacking events that we would see 10 to 15 years ago. They're coming from someone doing something really simple, seeking a vulnerability, or someone creating a fake account. Like I remember I was talking to another founder, and this was like very much like a green light, like, a kid savings account that you could do work and get like gift cards. They were seeing people fraudulently creating accounts, transactions, and doing money laundering, or like using fake credit cards and then switching them to gift cards and then getting rid of them. Like that's the simple attacks are going. That's where the fraud is happening. And even now, like last year, or actually 2 years ago, 28% of Chime's accounts were fraudulent.
And like, because usually what happens when people, unfortunately, some gets wiped out, and just from talking to a few people that I know that did lose a lot of money, police don't really do anything. Is there ways between AI and everything, or is there any organizations that will work on a percentage for retrieving it? Because there's so many, like we're talking billions, maybe trillion. I don't, it's massive because I mean, if I know so many that have lost, and I heard Mark Cuban as well actually got caught as well. Like, and I mean, you would think he's as savvy as you get, but like, so it's there's so many people are getting caught with this. Is there an AI or is there a company or is there potential that would actually work on a percentage basis for retrieving the money?
You know, it's funny. Years ago, I met a company that was buying wallets that were like lost or keys were lost, and they would be buying them for like pennies on a dollar. And then and I said, well, why are you doing this? So I said, at a certain point, quantum computing will be fast enough. We should be able to unlock them. It never happened. That's really, really difficult to look at retrieval. It's really, really difficult to like, because here's the thing that people don't understand. And I learned this from another investor who had some like, because the real also fraud is coming from like, I'll use a good example. Like, you know, it's all coming from wire fraud. It's coming from social engineering, where someone sends you an email that says, you know, Adrian is sending Roy an email. Hey, Roy, I need your password for your wallet because I'm going to send you money. And you're like, oh, Adrian's sending me money. And then you're like, wait a minute, that's not his real email. And then all of a sudden, boom, password's gone. And he saw this happening. And so he actually went and realized that it was a fraudster in China. And so flew to Beijing. They went to the courts, they went to the banks, and the banks were able to recover like a third of it or a half of it. And the rest of it was like a fractal. As soon as the money landed, boom, it got split up into 10. From there, it got split up into 10 more. From there, it literally, boom, it was all gone. It was like a fractal thing. And that's the thing that happens. Even if someone runs off of the wallet, bam, that's split up into 10 to 10x exponential transactions. Because they know what they're doing. They realize that they're not like, if this is like a blockchain attack, they're not going to sit on it and be like, oh, I have it over here. Don't worry about it. You can talk to someone. No, that's already moved. And that's the thing. There's so much other aspects of security because even now, like we talk to people that have like thousands of dollars in their like ATM card. And I was like, why do you do that? Like someone could steal your ATM card or even the number from a receipt and that money's gone. What are you going to do? And they're like, oh, wait, oh, this is a thing? I'm like, yes, it is a thing. Same thing with wallets. Like you have a wallet through PayPal. Someone spoofs your, dual authentication. That money's gone. You transferred it. There's no rights. Like they can't get it back.
With AI, then that's that you're different companies and looking at, because I mean I've seen a lot of the different AI. Recently is a China one. I forget the name of it, but that's competing with ChatGPT. So I presume like it's the programmers, because there's a few that kind of kicked me out even when I'm asking questions, because one of my podcasts I'm exposing fraud and corruption, and I kind of go deep, but there's some things you 100% know about, and it doesn't like it. So the problem is it's actually based on what's been programmed into it, as opposed to, and the other thing is, like, if this went out and searched every single book out there, because I mean, most of the books that I get good information are like from the 50s or even, 100 years old, and you get kind of honest stuff compared to the newer stuff. It's all been doctored. How do we, like, are you seeing people that are trying to have authentic, honest, even say if we look at the health side of things, because the reality is there's so many natural remedies that people can go away, and if it gathered it properly, it would be better than any doctor, because it would know what would be good before you try it, an alternative, but it's not done that.
It's a problem because it comes out to when you look at AI, like DeepSeek is the new one that everyone's talking about. Oh, it's going to disrupt everything. My view of it is, have you guys ever tried it? Have you tried it at all yet? And most people are like, oh no, but it's going to disrupt it. And it's like, no, we actually tried it. So one of the things that we do in-house is that we test LLMs with what we call a baseline question, which is a simple question. And this comes back from user experience research and usability research, where you ask a question to see a response. And that is a contextual question. So I'll use a baseline question. I'll use a good example. Like, if you were to say like, hey, do you like cats? And you say yes or no. That's a simple question. It's either it's an X or a Y. Like, but then if you start digging deeper and you say like, hey, why do you, or like when you think about a cat, what do you think about? And this person is like, they're cute, they're cuddly. And someone is like, I have allergies. So when you look at that response of yes or no, the person that was allergies that may have no, that's now sentiment because it's a negative sentiment. They don't like cats. They really don't like cats because there's a negative sentiment. And so questions have to be contextualized with whether or not this is going to be a positive response or a negative response. Same thing with when we did user experience research, when I had my startup, we would ask things like, we were doing things for people that were commuting. So I would ask, like, when we were doing user experience research, like, do you work from home? Well, if you work from home, you're clearly not commuting. So therefore your data should be X'd out from the data set. That's not happening right now in LLMs. And so when you look at like our baseline waste, as in going back to the first comment, the dog's name is VC Puppy. We'll ask, who is VC Puppy? And so we asked Google Gemini, and Google Gemini came back with this crazy answer because a lot of LLMs, when they don't have the answer, they hallucinate. Translation, they make stuff up. And it came back with this response of, he's a nickname for a guy in VC. And I was like, oh, this is going downhill. So we asked ChatGPT, who is VC Puppy? ChatGPT responds, he's also a nickname, but he went to Stanford and he went to Harvard. And here's the reference article. The reference article is made up from another website that said the plush dog went to Stanford and Harvard. Clearly, it's using fake data. It's not hallucinating. It's taking a fake reference point and giving it as an answer. So then we asked DeepSeek, and DeepSeek said, I don't have any data on this person. And we dug in deeper. We coaxed the answer and said, hey, is VC Puppy work at Mendoza Ventures? And we say, hey, we saw somebody listed on the website, but we still don't have any answers. And then we went again and kept on coaxing it to be like, is VC Puppy a plush dog? And they're like, well, mascots are typical in areas like venture. That was a good response, but it's a response based on insufficient data. So then we went back to ChatGPT and I asked it, who is Senator Mendoza, one of the GPs at the firm? Very public personality. ChatGPT came back with, here's this thing about her from the Department of Commerce. Here's this thing from the Mendoza website. Here's pictures. I went to DeepSeek. It said, I don't have any data available. That means even if you asked it a question, it doesn't have access to data sets. And so without enough data, it's going to give you answers that are accurate. And then as more and more people use it, so DeepSeek is where ChatGPT was 3 years ago. In the beginning, ChatGPT couldn't really give you good answers because there was enough data set. And then people started feeding it more stuff. Well, if you feed it garbage, you're going to get garbage out. So just like how ChatGPT says VC Puppy went to Stanford and Harvard, it's feeding you garbage. And so I think this is the problem with it, is when you ask it, if you're asking it for write me a job description, there's enough job descriptions for a computer scientist. When you ask me to plan your wedding, there's enough like stuff out there. When you're asking it for things like, tell me about a medical condition, tell me about an insurance claim, this is where things are going wrong. And so the real future is not on LLMs, it's what we call SLMs, a small language model that is focused on a very specific domain. And that's what's going to be used to fix fraud. Because if you're using the big LLM and you're trying to use it to fight against fraud techniques, and the fraudsters are now throwing in garbage in there, you're going to get garbage techniques. But if you can create a walled garden based on known techniques, known fraudsters, known attack vectors, then when you go back to trying to use AI and an LLM based or an SLM based approach to figure out how to stop you from getting frauded or getting attacked, that's where it's going to help. But we're not there yet. There has to be enough of these very specific models that are focused on, and this is where the concept of agents is coming out, is we now need to have an agent for healthcare, an agent for crypto trading, an agent for tokenization, where they're very domain specific for you to get a very specific answer and lower the hallucination.
And I mean, I find it scary that unfortunately a lot of people, when they do their AI search or they go, hey, Alexa, tell me this, or a Google search, they're taking it as gospel and as a truth. And then they're sharing all that information, which unfortunately a lot of people aren't able to decipher that this isn't true. And they take it as being gospel, and it just gets more and more. And then they're feeding more information based on what they've just learned, thinking it to be true.
Oh, and one of the things that I did is when I asked it the question of who was Senator Mendoza to DeepSeek, they have been claiming that they have the DeepSeek R1, and I hear people say, oh, it's fantastic, and it's very conversational. So I asked it, and I used DeepSeek, the R1, and it gave me a 2-page rant. And it says, well, this person could be an actress, and maybe they could be on Netflix. And I was like, dude, if I want to hear myself rant, I'll listen to myself on a podcast. Like, I don't need to go to a cheap AI to hear a rant about who I think, what I think this person could be.
With the company then, like your kind of diversity, women of color and stuff like that. So how did that come about? Because is it that they're not being served with other VC companies?
You know what? For me, the simple view is we look for the best founders and the best talent, regardless of what they look like and regardless of where they are. And that's really, it doesn't matter. You can find incredible talent everywhere, because right now everybody thinks, oh, the talent is coming out of Stanford and Palo Alto, or it's coming out of New York. Like, it could come out of Cork. It could come out of Port Leash. We were talking about Ireland. It could come out of Indiana. It can come out of anywhere from anyone. And part of it is, our view has always been that, and this is the issue with venture and with investors. Investors are local. The Irish funds invest in Ireland, the New York funds invest in New York, the Silicon Valley. We invest nationally across the US. And our second fund actually invested internationally. So we invested in US, Canada, the UK, and that fund had investors from across 6 different countries. We had investors in Ireland, in Australia, we had investors in the UK and Canada. We had an investor in Norway, because their view of it was we wanted exposure to a national brand that could invest and find the best talent everywhere. And that's really has been what we do best in over the last 9 years, is looking for that talent, and that talent comes to us and we're happy to talk to them.
When people are pitching, especially international, I mean, is it they're going through a phase that they're sending all the information in, and then you sit down with them face to face? Like, what's your process for people that are actually pitching to you?
The nice thing is we have this incredible program we built about 3 years ago called our Venture Fellows. And so we bring in MBA students from across the country, some of them international, and some of them will work here at our office. Some of them will work remote. And what they do is they're going through the pipeline. And what we have to do is we have this massive pipeline. And the reality is, we look at thousands of companies a year. And I'm not making that up. Like, we look at a lot. And a lot of them we have to say, like, the fizzy juice company, this is not a fit for us. Sports, dating, like, we will get everybody that founders will send everything to us. And look, I was a founder. I did it the first time. And after a while, it was like, no, this is a sales process. You have to identify who is the right investor for you. If you have a fund that only invests in technology and fintech and AI and cybersecurity, don't send your fizzy juice company to that firm. No offense to the fizzy juice guys. I'm sure it's delicious. But that's where, especially when you look at international founders who want to come to the US, it's really about like looking for the best investors where that there's going to be a good fit. The other thing, which is an important trend, is that a lot of investors, like in our case, we are backed by some of the largest banks in the US. They have limitations now on, well, you have to invest in US domiciled companies. So when you look 5 years ago at firms in LATAM, most of them were domiciled in Mexico or in Puerto Rico. Now a lot of them are domiciled in Delaware. And so now when we look at a lot of international companies, we'll ask, where are they domiciled? And in some cases, we had a company that we're looking at LATAM. We said, we would want you to domicile in Delaware. And they said, great, we'll do that. Out of our third fund, we had a company in Calgary that re-domiciled to the US and moved their offices to Boston. So I think there is that opportunity, but you've got to make sure that, one, you're lining up to the right investors, but also that the move works for you because of the customers that you're going to find. Because it doesn't mean like you want to domicile to a random state and then you're like, now you're there, but there isn't like the customers and the ecosystem that you need to help scale the company.
Like when you kind of invest, are you trying to get somebody on the board as well? Or is it just pure financial? Because I've seen a few times where people, they get the big money and then they want to build out the fancy office, they have the fancy car, and before they know it, they burn through all the money and it just collapses.
Yeah. No, we usually, lessons learned on this funding, we like to have someone on the board. And a lot of it time is because we're coming in and we're building out the board for the first time. We're making sure that there's an independent that's helpful. But for also us, it's the ability to having view into financials. Because a lot of times, this may be a first-time founder who's never built out or scaled a company before. And even that, like I remember one of my first investments years ago, I sat down with him and said, this is where the movie's going to go. At a certain point, you will be replaced as a CEO because you've never scaled a 100-person company. And he was like, oh, wow, really? And of course, just like I said, a couple of years ago, he was replaced when they got over to 100 employees. And so that's part of it is we realize that in order to be an advisor and mentor to not just the company, but to the founder and the management team, you can be an advisor as an investor, but it carries more weight when you sit on the board and you now have a vote on your money and also on the direction of the company. And that's really important. And that's also important for us because when we meet the founder, a lot of times we're building that board out and it's about building the board out to the future. Like it's not just about the now and what can help you now. It's what can we do to build a board and bring in an independent and observers to get you to the next funding round and then the following next funding round as well.
And for those that kind of work with venture capital funds, because not all are there for, a win-win situation. Sometimes, they see an opportunity and then what they do is they go, oh, we need this amount, and they dilute them. And before they know it, they've got like maybe 1% of the company that they founded, created and everything. How does a person protect themselves with companies that are out to actually just rip them off when they see a golden opportunity?
You know what? It's hard because the biggest lie that founders tell themselves is I prefer to own less of nothing versus something that's worth it. So I could own 100% of nothing or 1% of something. I think that's the biggest lie that founders tell themselves, thinking, oh, if I get diluted, it's that 1%. At the end of the day, it's 1%. And part of it is they have to, what I have always told founders is not every company needs venture capital money. Like if you can build a profitable business by yourself, build a profitable business, build a cash flow business. But if you want to scale that business, and this is where things go wrong, is people raise a lot of money when they're not ready to scale yet. They don't have product marketing fit. They don't have a product. So they burn through a lot of the money in building things and that people no one's buying. Our view of it, because we have been founders, and especially it's a lot more in when you look at the fintech and when you look at sort of the digital token side, because a lot of people, what we saw in the past, were building products that were never regulated that never got past the regulators, that can never go through risk compliance at a bank. And for us, we tell them, like, one, as a founder, have the domain expertise and start lining up the first couple of customers. When you're there and you have that first amount of revenue, then start looking at raising money. But, if you're raising money, so we looked at a company that I love the company. I love the founders. They raised a lot of money. The majority of that money was going to customer acquisition costs. And I was like, you're literally paying Facebook and Instagram and TikTok for users and not for the building the value of the company. You're going to end up raising more money. And now guess what? Founders get more and more and more diluted versus if they had built a profitable business, took less cash. Because one of the things that we also like, I have conversations with founders that when they get to scale, I look at them and say, you don't always have to sell equity. You could also look at credit. You could also look at other alternatives to not sell more equity, because the farther you go, the more the cash gets more and more expensive.
And is it better when the person comes to you and has the exit strategy in mind at the start, as opposed to the person that wants to hold on to the baby no matter how much it's crying?
Well, it's hard because there's a problem with both of those scenarios. There's the person that holds on way too long and the person that's already planning their exit before they've done anything. And I've seen that. I've seen a founder who is like, oh, I'm going to exit and, I'm going to do this and I'm going to be an investor. And I'm like, 7 years later, exit still hasn't come. And I'm like, yeah, no, it doesn't happen. Like, you say that when you're there. For us, and also I've had a founder that I remember talking to and was like, hey, if someone offered you 50 million, would you sell the business? And they're like, no, I'm going to IPO this thing. And I was like, this isn't an IPO kind of business. And, it's the delusions of grandeur, but also, for us, when we meet the founder, we do about 3 to 6 months of due diligence, and we want to see like, what are exit opportunities? We want them to talk to us about like, who would be an early strategic investor? Who would be an early strategic acquirer? Like, are you thinking about that? Because I've talked in a lot of podcasts, I've talked to a lot of founders about planning that exit. That exit happens like when you want to sell a company, it doesn't happen overnight. This is 6 months to 2 years in the making of finding those companies, those potential acquirers. Because one of the things that we do, we invest in a company. We have a guy that puts a lot of our POCOs in front of the banks, in front of our investors every quarter. Hey, you should start tracking this company. Hey, they're doing something cool. Maybe they should be a customer, so that when they're ready and they think about, hey, I want to buy a company. I want to buy a company in this space. They think about who's already that they've been updating on. Who do they know already in the network that's already working with them?
And just finally, your wife works with you in the company?
She's one of the original founders. We were tech founders together, and we started Mendoza Ventures, just our family investing. And we did so well that outside investors came to us and said, we really like what you guys are doing. We want to invest. And we raised our second fund. And 5 years later, the banks came to us and said, we really like what you guys are doing. Can we invest? And we started raising our third fund. And really for us, it's, we put a lot of care into what we do, but also this is why, when we invest in a founder or someone invests in our fund, we say, welcome to our family, because just like family, I'm going to be on top of you. I'm going to be checking in. I'll be like, how's it going? And that's, founders have to realize that that's part of being a family, whether you like it or not. I'm going to come over to your house for dinner and I'm going to check in.
I've got a few friends that actually they're in business with their partners, and it works sometimes, and other times it doesn't. They just kind of it. What was your success? And are you able to go home in the evening having a meal and switch off from the business, or is it always there?
You know what? It's funny because one of the things is that people think that we talk all the time. We don't. We literally, like, I travel a lot for the business. I'm, visiting portcos in other countries. I'm visiting portcos across the US. I'm visiting some of our investment partners. Last year I was in Mexico twice. I was in London. I was in Tokyo visiting like our companies out there, visiting their customers. And people are like, oh, I told Jennifer something. And I was like, yeah, just because you told her something doesn't mean that like I hear it, because we're not talking about you at night when I'm asleep. What we do that makes it work is we have a scheduled time. Every Monday we have breakfast together, and we go through what we do on the family side, but we also go through what the firm is. What are we planning out this quarter? What are we planning out this week? And we make time to go through. But this is also why we build out a team, so that she and I should be able to get run over by a truck, and there's an investment team, and there's, people around us that can continue the business. That's really the power of what we built is, this is about not just her and I doing the work. And yes, my last name's on it, but it's building a brand and bringing people in to run the business with you.
No, excellent. Love it. Listen, thoroughly enjoyed the conversation, Adrian. You might let people know where they can find you.
Yeah, thanks, Roy. We can go to MendozaVentures.com, learn more about this there, but we're also on LinkedIn. Happy to, people send us decks all the time. People send out, hey, I want to learn more about being an investor. I want to learn more about sending. Always, for me, send a tailored note. Hey, I heard you on Roy's crypto podcast. Would love to send you a company. Would love to learn more about investing. I'm a big believer of sending tailored things and contextual messages.
Excellent. I'll make sure I put the link button, the audio and the video, and people can check out VC Puppy and see the pictures on Instagram. Yeah. That's all for the Crypto Podcast. You'll find all our episodes on the cryptopodcast.org. Be sure to give us a thumbs up, 5-star rating, share with your friends, and comment on what we discussed. Until next week, take care. So I hope you enjoyed this week's episode. As mentioned at the start, you can find my 6 podcasts on roycollin.com or scan the QR code if you're looking to start a podcast or do a podcasting tour. I help with that. Also, if you're looking for a virtual assistant, we also have that service. And you can help the show by visiting the store, supporting our sponsors, or making a donation. Until next week, take care.